I think that markets have been holding their breath. They've been getting defensive. That's why we've been bleeding for 5 days. And so now I think there's a relief and some capital gets put to work, and it's good for equities and risk assets. I think there's a lot of upside, especially because once you get an ISM back above 50, it really does argue for a broadening of markets. And I think one of the leaders probably comes from the financial sector. So I think towards the end of the year, 6,800, 7,000 is possible. It's a really important moment happening this year with the Genius Act, really greenlighting stable coins, and then Project Crypto, which is Wall Street moving on to the blockchain. I think it's a lot like 1971 when the US dollar went off the gold standard. That created the innovation of Wall Street because they had to sort of essentially create this synthetic dollar. Wall Street moving on to the blockchain is a bigger moment, and I think that's why Ethereum is essentially having its 1971 moment equivalent.
Tom Lee opened his commentary with a firm message. The Fed is turning dovish again. Lee believes that Jerome Powell's recent tone signaled concern over a softening labor market, not inflation. According to him, the Fed now sees tight labor conditions as no longer inflationary, and that marks a significant pivot. This is a green light for equities, particularly small-cap stocks, which he notes were already up 3% following the Fed's comments.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Well, I think that it's the Fed acknowledging that the risks now are tilted for the labor market to be softening, and they want to head that off, especially because they don't think that tight labor markets are going to necessarily create inflation. That's a very good sign, and I think it means we have a dovish Fed again, and that's kind of a green light for small caps.
Small caps
and for equities.
They are working. Last I looked, small caps were up 3%. So is this what we need to really confirm the sort of broadening that comes and goes in the market?
Yeah, because I think that one of the things we should watch for is what happens to mortgage rates. But mortgage spreads are right now 360 basis points higher than the 10-year. Historically, it's 1.6 percentage points. So you could see a huge drop in mortgage rates. That's going to help housing, helps the financial small caps. And I think already the ISM, which has been below 50 for almost 30 months now, could finally go back above 50, and that's a good sign for industrials.
Although we had a discussion right on the heels of the speech about a little steepening in the curve. Is there a sense that the vigilantes are at least present, if not being necessarily vocal?
Yeah, but we could also be steepening because growth expectations are improving as well. So this could be like what I'd call a bull steepening. I'm not really sure what the fixed income terms are, but I think it's actually a positive sign for growth.
The only real losers today are going to be some of the yielders and some staples. Would you be cautious on those?
That's right. I think that markets have been holding their breath. They've been getting defensive. That's why we've been bleeding for 5 days. And so now I think there's a relief and some capital gets put to work, and it's good for equities and risk assets.
So, all right, we need to make some news here, Tom. Everyone listens to you. We're at record highs now for the S&P and the Dow. How much more can these stocks rally?
I think there's a lot of upside, especially because, once you get an ISM back above 50, it really does argue for a broadening of markets. And I think one of the leaders probably comes from the financial sector. So I think, towards the end of the year, 6,800, 7,000 is possible.
Led by tech still?
Yeah, so I think you still want to play
this week.
Yeah, you want to be long AI and the crypto trade because those have been the market leaders, so the Mag 7, Bitcoin, Ethereum. But the broadening is really the financials, industrials, and small caps.
So you like them all?
Yeah, it's kind of cyclicals, AI and crypto, but not the defensives.
Your crypto calls have been getting a lot of attention lately, especially on Ether.
Yes.
Where we were talking earlier, we were debating whether it's the future of the financial system. A lot of people are thinking, people like you have said that.
Yeah, I think it's a really important moment happening this year with, the Genius Act, really greenlighting stable coins, and then Project Crypto, which is Wall Street moving on to the blockchain. I think it's a lot like 1971 when the US dollar went off the gold standard. That created the innovation of Wall Street because they had to sort of essentially create this synthetic dollar. Wall Street moving on to the blockchain is a bigger moment, and I think that's why Ethereum is essentially having its 1971 moment equivalent.
But a lot of people just see it as wild speculation and froth.
You know, I'd say anytime something goes up, people tend to call it froth. I think they called AI a frothy trade now, but we know it has a lot of legs and it's been taking place for a couple years. Keep in mind, Ethereum is also the place where when agentic AI comes together, you know, when you have robots and you want proof of human, you want to make sure those commands come from, you know, a verified source. That's all taking place on a smart contract. A lot of it will be Ethereum.
Well, I think that Bitcoin is a very volatile asset, and what we know is in bull markets, usually there are these drawbacks, but the drawbacks historically have been 30% drawdowns, and these haven't been 30%. These have been more like 10, 15% drawdowns. And so what I think we're watching is a market that's maturing, institutions are coming in, it's getting bigger, and so what you're starting to see is kind of muted volatility. And that means that people who are hoping Bitcoin's going to go to $400,000 or $500,000 in a bull market, this cycle is probably not going to happen, but also people who think that you're going to get, you know, kind of 85, 90% drawdowns in the bear markets. That's probably not going to happen either.
Okay, so if neither of those things are happening, maybe it looks a little bit more like what you've always said, gold.
Well, I think that Bitcoin has gone from a contrarian trade to consensus trade. In order to do that, you need it to become less volatile. Because for institutions, what they want is they want something that is more volatile than the assets they hold, but they can't have something that is going up, you know, hundreds of percent and down 90%, and they have to constantly report kind of a mark to market. And so what I think you're watching here is just the maturation of this asset. And then what I also think is pretty interesting is the holder base is rotating. And so you went from kind of a pure retail audience that, you know, frankly is subject to fear and greed to now you have a lot of institutions that in public companies, they're not going to sell. You have the ETFs, they're likely going to act very differently. And so I think that this is all kind of natural and a good sign for Bitcoin in the long run.
What do you think the floor is from where we are right now? And what do you think the upside is, given that, as you said, a lot of folks who come on our broadcast, Kathy Wood and others, who would tell you that, you know, she thinks this is supposed to get to $500,000 or $1 million a coin.
Zero and infinity.
Yeah.
Okay. Well,
I think that Bitcoin will definitely go to $1 million at some point in the future. I just think this cycle, right, it's very unlikely that it's going to go to $1 million. And so what is the floor? I don't know, right? What I do know is right now at $112,000, $113,000, it's pretty oversold. And so I would expect that you have two things lining up. You've got kind of the overselling of Bitcoin, and you're headed into kind of September, October, which is usually a pretty good time, especially if it is the year after a halving. But also, if you look at like the VIX seasonality chart, usually right about now, you'll start to see the VIX really start to kind of move upwards, and we get a lot more volatility. And so I just think that it's August. People are on vacation. They're tired. They're, you know, not paying attention, and things kind of just draw down. And starting in September, we should see Bitcoin kind of come back alive again.
because of what, though?
Well, I think there is kind of a simple thing of just like people are in front of their screens in September. They're not in front of their screen in August. And so people are buying and being more active. But also, I think that you've got a lot of speculation on a Fed interest rate cut. I think you've got a lot of the people who raised capital for these Bitcoin treasury companies that are going to start buying in kind of late August, early September. And then I also think that if people believe that the end of Q3 and the beginning of Q4 is a good time for Bitcoin, people start to act in a way that makes that.
But the folks that are selling, you think are selling for what reason? And the reason I'm asking that is I've heard from a bunch of people who have actually sold some Bitcoin, moved it into Ethereum. That actually has been one trade for some folks. There's another trade among sort of folks who are interested in blockchain, but not necessarily Bitcoin per se, who've actually bought into Circle, for example, publicly traded company that sells stablecoin, you know, that it's a stablecoin business. Do you see people moving from one place to the other?
Well, some people are definitely doing it. I don't know if I would suggest people do that. You know, the whole blockchain, not Bitcoin, is kind of like a 2016, 2017 viewpoint. I think that that's been pretty much disproven that Bitcoin is the king. It's been the king. It's going to remain the king. But on top of that, I do think that there's a lot more opportunities for people to play this. And what you are getting is you're getting capital markets where people are optimizing for different things. Some people want yield. Some people want infrastructure. Some people want the actual underlying asset, Bitcoin itself. And so I think that you're going to get fracturing of capital, which again leads to that muted volatility.
As for current crypto market behavior, Lee notes there's a rotation happening. Some investors are moving from Bitcoin to Ethereum, others are betting on stablecoin infrastructure like Circle. He sees this as a healthy evolution, not a threat to Bitcoin's dominance. In fact, the fracturing of capital across multiple crypto instruments is contributing to lower volatility overall. Lee remains firm. Bitcoin is still king, but the ecosystem is expanding, allowing for more diverse strategies, from ETFs and staking to infrastructure and layer 2 investments.
In terms of ETFs, what kind of volume are you seeing going there versus what's at people buying the underlying asset?
I think
and
that
how much does that matter?
Yeah, I think there's still a lot of people who they can't buy Bitcoin, so they're going to go buy the ETFs. Now, one thing that I do think is pretty interesting is I have seen a number of people in the Bitcoin community who, are purported to have large holdings who have said, hey, look, actually, I'm going to convert the Bitcoin into the ETF because from a security perspective, it's something that somebody can't necessarily hack or take from me. I don't think that's going to be the norm. I think that you're still going to see the Bitcoin community talk a lot about kind of not your keys, not your coins, and make sure you have custody of the asset. But there are people who are doing stuff like that.
Well, first of all, I thought it was very dovish, and I think the market reaction is perfectly right. Listen, small stocks doing so well is textbook. Small companies borrow at the Fed rate, at the Fed funds +1, +2. They are very sensitive to those short-term rates, which now we're going to go down. I wouldn't be surprised to see it 25 basis point at each of the next 3 meetings. Down to the low 3s by the beginning of next year. I think it's appropriate. I've been saying that for quite a while on CNBC, that the short rate should be about 100 basis points below the long rate, and that does put it in the low 3s, and I'm not surprised at the reaction, and I think this means more upside for equities.
I guess the question is, you say you thought that Powell was more dovish than maybe we were led to believe he would be. A lot of folks felt like he would not want to close off various options, right? You have Morgan Stanley, Bank of America. A lot of these big firms do not have a forecast for rate cuts this year, which says to me that there is a relatively robust counter case to the idea that we should be cutting right now. I realize it's at inflection points you're going to get this disagreement. But the idea that Powell is perhaps going to tolerate, cosmetically high headline inflation numbers for the next few months, you think the market can continue to be good with that, even if, let's say, long rates were to leak higher?
Well, first of all, the Fed never forecloses anything for sure. It always does leave that option open. But it's the first time I really heard him say that the tariffs are a one-time increase, and implying that as long as that doesn't spread to other sectors, just, as Steve mentioned, that we should not be looking at that inflation and saying that that's one reason to tighten credit. I've often said, tariffs are like a tax increase. Monetary policy says you should not tighten credit when increased prices is caused by a tax increase. And it seems like pretty much he was on board with that notion. He hasn't seen inflationary expectations go up. My belief is that, the inflation data in the future may not be as important, particularly if it comes from core goods and from tariffs and imports. He'll be looking at the service side of it. And by the way, we know housing is a big part of that service side, and that's been very soft. We see that prices in homes across the country are finally softened to the point of going down, I think, in a majority of states right now. So housing, even though it does get in a lag in the CPI and the PCE deflator, doesn't seem like that big component is going to be a source of that service inflation. So I think that, pretty much that opens the door for those lower rates. And I think that's pretty much the way it should be. And obviously anything can happen, but the market wanted it, and they got it. And it was more clear than I thought he would be.
Wrapping up his macro outlook, Lee mentioned the seasonality of markets. August, he says, tends to be weak. Investors are on vacation, trading volume is low, volatility is often subdued, but come September and October, things usually pick up, especially in a post-halving Bitcoin cycle, and if the Fed leans further into rate cuts, crypto could stage a powerful comeback. Add to that the VIX seasonality, with volatility expected to rise and fall, and we might be setting up for a risk-on Q4 across the board.